Fortune favors the bold, which is why billionaire Eric Sprott and legendary investor Rick Rule are taking advantage of the lowest valuations in the mining sector in over 3 decades by accumulating millions of shares of this tiny new stock led by Keith Neumeyer, a mining entrepreneur who has already built 2 separate billion-dollar companies. This new venture, starting with 18 assets on day 1, including gold, silver, copper, and zinc projects, has already identified 60 additional quality assets in distressed companies that management will work to acquire. To learn more about this incredible opportunity, visit futuremoneytrends.com/fortune.
Well, hello everyone, and welcome into crushthestreet.com. We got a great show for you today. We're got a special guest, actually, and you know what's been great about this show is we've been able to bring in a lot of great thought leaders across the board and just get so many interesting and just expert opinions on what's going on in the economy. And of course, that's been able to benefit us and to making decisions that are positive for our own future and figuring out how we're going to proceed in this new economy. So today we got Craig Hemke, also known as Turd Ferguson. He runs the site tfmetalsreport.com, and it's an excellent site if you want to get news that isn't just bogged down by mainstream agenda, and a site that talks about precious metals and among other things. Definitely check it out. So Craig, thanks for joining me today.
Ken, it's a pleasure. Thanks for the opportunity to visit.
Craig, I got to ask you about the name, and for everyone who might have missed it, the name is Turd Ferguson, T-U-R-D. I got to ask you about that. How did you get that nickname?
I wish I would have come up with something more glamorous when all this got started. Had I known that my life would diverge onto this path, I would have chosen something different. I've been involved in the market since I was in college back in the 80s. I was trading commodities with a brother-in-law who was a commodities broker, and have traded options and futures while I pursued a kind of a regular career as a stockbroker and then what they also call a wholesaler of other financial products. But I decided I wanted to get out of that business in about 2000, well, right around the time that everything collapsed in 2008. I'd always had a dream of starting my own business and getting off the corporate ladder, and so I did. And what I found is, since the timing was the same, kind of coincident to this great collapse, I kind of had my own great awakening about really what a fraud everything was, all the way down to to financial advisor level. And I don't mean to call them all frauds or anything like that, but there's this idea that somehow there really is a market going on of regular investors, buying and selling off of the fundamentals. And it became clear to me that really wasn't the case. And I had an awakening that was in large part due to my discovering of the website Zero Hedge. And again, that was probably early 2009. And Zero Hedge actually started out as kind of an inside baseball site, blogspot site for Wall Street proprietary trader guys. And I remember when I first joined there, people, they kind of looked down their nose at me, some of these guys, as if, because I thought I knew what was actually going on when I really had no clue. But I got involved in there early before it was really much of anything. And the day I signed up for that site, just like any other site, you pick an anonymous username. And I had just seen a clip, an old Saturday Night Live clip of Celebrity Jeopardy, where at one point the Norm Macdonald character he's being Burt Reynolds, and he changes his name to Turd Ferguson. And that just kind of had struck me as funny, and I'd probably seen it the day before. And so as I signed up for Zero Hedge, that was the name I picked. And I kind of developed a reputation and a following in regards to precious metals at Zero Hedge, and a lot of the users there encouraged me to start my own site back almost 5 years ago in the fall of 2010. I thought that was crazy at the time. I thought, well, who would read my site? But I did it anyway, and the site just rapidly just exploded into one of the busiest precious metal sites in the whole world. And then it has transformed itself over the years into this TF Metals Report site. And so that's kind of how it all came about. It's a great site. I not to simply plug me and what I do. The site itself is mainly composed and driven by all of the users.
That's awesome. I mean, that's amazing how it started off as you being just a commenter on another site. But I'd like to ask you a little bit about that transition. And as far as your investment strategy goes, being a financial planner and then having this awakening moment, how has your financial strategy changed? How has it evolved in terms of being into the stock world and then kind of going towards the precious metals? Have you completely gotten out of stocks and are now just precious metals, or is there some sort of a hedge where you're still in some sort of conventional vehicles to park your money?
I don't do any trading at all anymore. And that's for a couple of reasons. And some folks say, well, this guy was so smart, he just would trade his own account. You really can't do both. There's just not enough time in the day to give the attention that trading deserves. Because if you're going to be successful at that, especially given the preponderance and the dominance of high frequency trading these days, if you're going to have any chance at success, it is, anybody listening to us that considers themselves a trader, no, it's basically a 16-hour-a-day job. You cannot be distracted but for even to get up and go to the bathroom, it seems these days. And this website takes all of my time. I run it completely by myself. I don't have, employees or, it's just me. And so you really can't do both. Additionally, though, the more important point is I think it's impossible for a regular trader to be successful at this point because of the domination of these markets by high frequency trading. What is it? 75-80% of the volume on New York Stock Exchange, the NASDAQ, is now HFT machines just simply swapping stocks back and forth to each other for fractions of a penny. This notion that the stock market is what it was when I first got into it 25 years ago, of somebody buying a couple hundred shares of Coca-Cola or $25,000 worth of a mutual fund, and that's what moves the market on fundamentals. It's nonsense. The market is now driven by these HFT machines, and they are all taking their cues from just a handful of signals that the global central banks seek to influence, whether it's Forex or certain other indicators like the VIX. And so the markets aren't fair, all the way down to the commodity markets. They're driven by HFT as well, where the bullion banks kind of lead the speculators into and out of positions as well. And so it's really not, to me, at least my personal opinion, it's not a winning proposition to be in there fighting around trying to own or trade stocks or trade paper derivative commodities. What we focus on at TF Metals is just simply the slow acquisition of physical precious metal as your protection against a financial crisis that has never ended, that has just simply been postponed by all of this central bank money printing and manipulation of data and manipulation of the news media, and knowing that the eventual end of this unsustainable debt crisis is still coming. We're just simply trying to prepare for that day.
Yeah, that's incredible, especially when someone that was on the inside comes out. And I always think it's interesting when people that are on the inside and they come out and they say, hey, no, this is fraudulent. This isn't working out. It's not just somebody that has never worked in the industry saying it. It's someone who actually came out of it and is saying, no, this isn't the way it's supposed to be. So having said that, what are your current thoughts on the economy? I know you kind of touched on that. With interest rates at 0%, and I know you also alluded to the fact that we never really came out of that depression recession we're in, but officially we're due for a cyclical recession. With this whole 7-year cycle, the stock market has just been banging up against 18,000, and obviously we've seen some volatility since then. What is your current outlook on the economy? And what's interesting, at least for me, is that historically, we've never gone into a recession with 0% interest rates. This is unprecedented times that we're moving into. So having said that, what are your thoughts?
I guess some would say that's why the Fed is so desperate to hike rates, either later this month or in December or whenever, just as soon as the statistics that they purport to use to drive everything, if those statistics do say recession, then they can again cut rates, in the traditional way that they always seem to pretend like they had control 10 or 20 years ago. And remind everybody too that the Federal Reserve is it's a private corporation owned by its member banks. And so when the FOMC meets and decides that they're going to change the level of the Fed funds rate or something like that, nobody should think that they're this altruistic bunch that is simply out there trying to help the whole economy and that they've got this dual mandate and all this kind of stuff. They're going to do what they think is best for their member banks, first and foremost. And so if we all sit here and look at the economy and say, well, the economy's moribund and still not moving, and record amounts of people that are either unemployed or underemployed or not in the labor force, and the only reason they can come up with any positive GDP growth is because they double and triple seasonal adjust the data. They come up with jobs, but they're part-time jobs, or they're just simple statistical guesses through their birth-death models and their seasonal adjustments there too. But if the Fed wants to raise rates because they think it somehow benefits their banks, then that's what they'll do. It will exacerbate what is currently driving all of the markets, which is this, I call it the disinflation bias. We really saw it start to rear its head a year ago this time. Commodities were collapsing. If you remember back into September and into the middle of October, the stock market really collapsed too, down to where, just below where we are today, before it began the first of about 20 V-shaped reversals over the next 12 months. It's finally, though, I wrote a thing about a week ago, and perhaps I'll send you the link, Ken, if you'd like to include it. It's a trend we followed all through August, and what we were looking for is what I call a death candle on the long-term S&P chart. We didn't know it was going to happen in August. We've been waiting for it because previous death candles in 2000 and 2007 had marked the end of those previous bull runs in the stock market. And what I mean by a death candle is just if anybody's ever seen a candlestick chart, just a big, ugly, long, nasty red down candle. And with the action in August, we painted onto the current monthly chart the exact same, almost identical monthly candle in terms of total monthly range, and then the percentage that we ended up down in the month, about 6.5%. Almost exact same type of action that we saw that marked the end of those runs in 2000 and 2007. It wasn't immediately straight down in either of those two occurrences. There was some kind of dead cat bouncing for 60, 90, 120 days. But then finally we did go down. And in those two previous occurrences, both more than 50%. So I would really encourage everybody to pay attention to that, knowing that this very likely does mark the end of this current run from 2009. If the Fed's going to start to tighten, that almost completely puts the nail in the coffin. And if history is any guide, if history does repeat itself, we're going to come down from a high of 2130 on the S&P. More than 50% takes you down to 1100 or so. So people need to be aware of this. You don't want to just get caught up in the CNBC hype that, all is well, and it was just a little and maybe it was. But gosh, if you've been lucky enough to see your 401k recover from where it was in 2009, now's not the time to be sitting on your hands and just thinking everything's always going to just keep going up. Now's probably the time to be cautious if history is any guide.
So talking about what could potentially happen in the future, we have the global economic system, all these countries with essentially 0% interest rates, and historically a fiat currency system that just doesn't last. And right. I'm wondering, we're kind of at the end of this whole thing, and it would, for everything to crash, that would mean people potentially likely going to dollars, conventionally going to dollars. Now, if the currency system fails, well, that should spill over, and not just spill over, but have people flooding over to precious metals. So I'm curious, what could you think happen? And if we did see some sort of currency collapse, could we see stocks actually go in the opposite direction and take off because of the underlying businesses that are representing the shares?
That's one of those really impossible puzzle to figure out, because we're dealing with something that we haven't really seen before. This type of changing of the guard, if you will. What's hard for people to understand, if I can take it back a step further, it's really hard for people to even begin to contemplate that there could be a changing of the guard, because there's really no one left alive, Ken, that remembers what it was like when the dollar wasn't the reserve currency of the world. I mean, you think that came into place after World War II. So to know what it's like when the dollar wasn't the reserve currency, you got to go back to the 1920s or 30s. So there's nobody left that remembers that. So it's really hard to overcome kind of a normalcy bias to think that this is just the way it's always going to be. And if there is some type of fiat collapse, again, and it's almost inevitable because, well, it is inevitable. What am I saying? Because the debt level is unsustainable. I mean, it's moving so exponentially quickly at this point. As it compounds and compounds, it's like my grandmother always used to tell me, just make sure you don't just at least pay the interest on your credit card every month, because otherwise, that interest starts to compound and goes exponential. And that's where we are. And so all you can do is continue to print more and more to service it, which is why the Fed wants 2% inflation every year, to create more and more money to service all the accumulated debt that the banks then charge interest on. That's another story. But the moral of the story is, yeah. And we don't know where it's going. It's really hard to forecast where it's going. How that will impact the stock market or individual companies. Again, all I know is physical precious metal is the protection against all this madness. It doesn't mean you take just like anything else, you don't take all your money and put it into stuff like that. And we've never discussed that at TF Metals Report. You don't want to cash out everything you have and buy gold, because you don't know how much longer the powers that be can keep things going. I mean, I would not have thought in 2009 they could make it to 2015. But this day is eventually coming, which is why you have to continue to prepare for it, because it is really a mathematical certainty that this end is coming. And so you just continue to try to make sure that you're aware of what your surroundings and what's going on, and again, prepare by owning some precious metal.
I wanted to ask you a little bit about the Shemitah cycle. I don't know if you've done any research on this or not. I just think it's real interesting that every 7 years we have seen this cyclical potential collapse and stock market crashes, and we are seeing already starting in August here, the market's kind of getting shaky. Do you find this 7-year cycle and just kind of some of what a lot of people are talking about as far as conspiracy goes, do you find any sort of relevancy to this, and what are your thoughts?
That is just not my bag. When I first broke into the stockbroker business, I was working for Payne Weber, and they sent me to New York for a week, and I got to kick around on the floor of the exchange, which they don't let people do anymore when there's really nothing going on there anymore anyway. And I actually met a guy by the name of Art Cashin that's often on CNBC. And Art now is about 75, I think, years old. He's run floor operations for Payne Weber and UBS for decades. And his line always was, don't go around predicting the end of the world, because you'll only be right once. And that's true. And it remains true to this day. And so first and foremost, I always kind of keep Art's words in mind. Second, though, and probably more importantly in this regard, is anybody listening to us right now, if you have access to a simple charting site like barchart.com or investing.com or something like that, you can go and look at the last day, week, or the last couple of months of chart action. And if you plot the US dollar versus Japanese yen with a chart of the S&P futures, you will see them moving in exact one-to-one correlation. And so what that tells me, again, this gets back to this HFTs and the ability of the central banks to influence the stock market by influencing a key factor that these high-frequency trading machines follow, which is that Forex pair dollar-yen. So if our markets now are not a human market, okay, of human emotions and human economic cycles, if they're not that anymore, then all of this stuff, the Shemitah or the Kondratiev waves or all of the cycles or all the Elliott wave, A, B, C, subcycle 1, all that stuff, frankly, you can throw it all out the window, because that all relies to a great extent upon human beings making decisions. And what we're seeing now is all of these global markets are utterly they're not flat out controlled, because that means you've got central banks actually managing it tick by tick, but they are so utterly influenced by the central banks that are trying to purport this vision of normalcy to keep things going, and they're driven by these HFT machines. There's no humans left. That's why the floor of the New York Stock Exchange is a ghost town. And so anyway, putting that all back together, like I said, if there are no humans left, then all of this study that had some relevance in the past, all these different cycles and wave counts and all that stuff, none of that really has any relevance going forward, just because to some extent they can keep these plates spinning. Now, I don't think they can keep it going indefinitely, but to tie the ultimate collapse of it to some date in September, I think is kind of a fool's errand. And I wouldn't, it's like that dude in Japan, that led everybody up to the mountaintop because the world was going to end, then the world doesn't end. They all come down, well, I guess we're right. I don't want to be the dude on the mountaintop.
You totally agree. All things in moderation. I guess what's interesting to me is all of this doom and gloom and the end of the world and the 7-year cycle and predicting. What I'm seeing and what I'm potentially wondering is all of this being a self-fulfilling prophecy in a sense.
Yeah.
With everyone worrying about it, now we're seeing the stock market sell off. And if nothing happens, could we see some sort of normalcy enter the market in, let's say, December or January, starting into 2016? Because, we didn't have this big buildup, nothing happened, now we're going to have a more comfortable sentiment versus just a very shaky sentiment throughout the markets.
And again, this goes back to the death candle chart that I talked about earlier, because this ability to influence markets could definitely make that whole death candle thing obsolete in terms of history repeating itself too. So I don't want to make it sound like I'm ignoring what I mentioned earlier. But what you point out, though, Ken, is exactly right. That the reason why technical analysis works, it works really well in smaller and smaller markets where everybody's looking at the same charts. If it's just a small group of people and we're all looking at the same chart and we all see, there should be resistance at $10. Well, guess what? It's a self-fulfilling thing. It's like you said, no kidding, there's resistance at $10 because every market participant sees the same chart. So that's why that can and often does work. And so you're right in that regard, and that it could be self-fulfilling, and that everybody's so cautious and nervous about, what could be happening. In October's typically kind of a dicey seasonal time for stocks anyway, that the thing does kind of take on a life of its own. That definitely could happen. Again, I keep coming back to this thing about the high frequency trading machines. I mean, there's all kinds of articles on the internet that you can read. Nanex is a company that has done a wonderful job dissecting these flows within the stock market. That crash, what was it, 2 weeks ago today or 3 weeks ago today, whenever it was, 3 weeks ago today, when the Dow opened down 1,000, could easily have been down 4,000 if it weren't for the trading curbs that kicked in and just halted all trading. And again, why? Because all of the volume is done by these computers, and all of the computers were basically selling at the same time. And so
amazing. It was down 1,000, and then I don't remember how far it went back up, but I was like, wow, who is buying at this moment right now for it to go down 1,000 and then for it to shoot back up? I mean, that would take a whole lot of money to send that market back up. And
again, it's not you and I. It was never you and I. It was never some stockbroker in Kentucky telling his client to buy 500 shares of, GE. I mean, none of that. It was all this instantaneous computer stuff. And that's how we got down that far in the first place. That's how we could have been down 4,000. Again, the market, if you can think of me doing that kind of air quote thing with my fingers, the market is completely broken at this point because of this preponderance, this abundance of all of these computers rapidly trading back and forth. And the exchanges think it's great because, they collect a little fraction of a penny on every single trade. And so if they were to throw out 80% of the trading volume by banning HFT computers, well, all of a sudden CME's earnings would all go to hell, so they're not going to do it. And so they've kind of painted themselves in the corner with a reliance on this technology. And the technology itself is what has broken the market and probably one day will completely blow the whole thing up. And so, again, how this eventually plays out, whether it is something dramatic next month or not, we'll see. You mentioned, is it self-fulfilling? If the Fed does raise rates, there's a whole bunch of derivatives out there, interest rate derivatives that are structured off of zero interest rates. There could be all kinds of triggers that could just push the whole thing over the edge and make it to where the machine sells so fast that the Fed can't save it, that the ECB can't save it, that the Swiss National Bank and the BOJ can't save it. So there are a number of things that people should be nervous and cautious about as we go through the fall. And I guess getting back to where we started, boy, now's a good time to be maybe taking some profits and just kind of letting it play out.
So talking about this uncertainty in the markets, what conventionally should do well is precious metals. And it's kind of, I think, bewildering me and maybe a lot of other people as well, that we are seeing a lot of uncertainty in our markets, but yet gold and silver, they're not really acting in the way we would expect them to act. So I would just like to get your thoughts on precious metals and what you potentially see going forward.
Just as we just discussed in the stock market, everybody has to realize that the paper derivative price, if you will, on a daily basis of gold and silver is derived by this computer trading, same HFTs, same hedge funds, same program traders. There's maybe 30 to 40 large trading funds in the silver pit, if you want to call it that, versus a couple of banks. There's maybe 60 the same market, large spec market players in gold versus 7 or 8 bullion banks. And it is a trading back and forth of contracts that is done there that sets the paper price. It has no fundamental connection. It has no connection to physical supply and demand. There's a great report out just this weekend by a guy by the name of Ronan Manley that works at a company called Bullion Star that discovered that the LBMA, the group responsible working together as bullion banks to deliver physical metal in London, has completely cooked the books, hidden the true demand of physical metal and the sourcing of that physical metal since 2013 from London and the West to the East. Ultimately, that it becomes a question of how much gold is left. And again, none of this is reflected in the day-to-day paper price. Now, the paper price still has legitimacy and is the price because there is some physical delivery being made at that price. But what we're all waiting for is the day when physical deliveries are no longer able to be made at those prices. And so I would just, at this current time with this oddly counterintuitive move of the price of metal, which again, it also is based off of movements in the yen versus the dollar. And we can talk about that too, if you like. But now is the time to be doing what the Chinese and the Indians are doing, taking advantage of this computer-driven low price to accumulate even more metal, to swap out of your paper currency reserves and add to your physical hard asset reserves. This will change. This isn't, like I said, it's not an economically fundamentally sound price. There's not a physical 1-to-1, 1 ounce sold to 1 ounce buyer market anywhere in the world just yet. But that day is coming, and this current system will sometime end. But in the meantime, hey, look at it as a gift that you can take 1,100 rapidly devaluing fiat dollars and exchange it for an ounce of gold.
Yeah, no, that's great advice right there. Are you leaning in either direction a little harder in terms of gold or silver? Do you like the price of gold? Do you like the price of silver? What are you more likely to buy at the moment?
That's always a fun question, Ken. From a historical standpoint, you almost have to be buying more silver than gold just because the ratio of the price of one to the other is so out of whack with what it's been historically. It's about 5 times out of whack. Most folks say it should be about 16-to-1 because that's roughly the amount of available silver to gold in the U.S. or in the global crust, they say. But what is it now? 75 or 80-to-1, which means that silver is vastly undervalued compared to gold. I don't know. It's hard to stack a lot of silver though because $10,000 worth of silver fills a pickup truck, where $10,000 worth of gold barely fills your pocket. And so, and I just know, I'm very confident of the role that gold will play in the next global financial system, whatever supplants the dollar in the years and decades to come. Silver probably will have a role too. It has a longer monetary history than gold does, but I can't say with certainty that it will. And so I've just always had I played more of a favorite with gold than I do silver, though I certainly own both. Additionally, I just want to say, there are a lot of forecasts out there about gold and what its true real value is, and so $20,000, $50,000, all this kind of $10,000 an ounce. And really, that's impossible. I want to say it's very nice that people make these forecasts, and I can tell you for all of them, they're all just simply guesses. And the reason I say that is because we really have this article I referenced earlier by this Ronan Manley guy. We really have no idea how much gold is left in the West, whether it's here in the US or whether it's in the UK. All of the central banks of Europe that have leased all of their gold out, and they hold promissory notes and leases from the bullion banks. We have no idea how much gold there really even is anymore in the West. And so without knowing how much gold is actually available, it's impossible to guess how much it's worth. All I know is it's worth more than $1,100 an ounce. No doubt about that. And so it's a tremendous place for people to continue to store their wealth.
Yeah, it's going to be an interesting time, too, when we do have that financial collapse and people do have that race and that flood into precious metals, because at that point, people are going to want to know when to get out, when to sell, and what to transfer their metals and their wealth into at that point, because like anything, it's going to go into that exponential bubble phase, and I'm sure that'll be a very interesting time. And I'm actually, optimistic that that'll happen in the short term. I mean, who knows, 2, 5, 10 years when we can see this whole thing really come and play out. So having said that, Craig, is there anything else that you wanted to leave us with? I wanted to wrap up the interview around this point and let you get on with your day.
I just think it's really important for people to understand that there are no markets. At least in my opinion, there is an illusion of markets. You can watch CNBC, you can see prices going across, and you can think, see, everything's just fine. Everything's normal. It's not normal. It's not normal. I mentioned earlier, pull up a 3-year chart of the US dollar yen relationship and plot gold over it. You want to know why gold's moved down for the last 3 years, even though the Fed was doing quantitative easing and all the ECB and everything else? It's because it's moved 1-to-1 with the yen for 3 years now. And why is that? It's because these high-frequency trading machines are set to follow the yen. It didn't have anything to do with economic fundamentals. It did nothing. And so people need to realize that there's this illusion. One day, that illusion will all fail. When we talk about selling gold, Ken, that is, okay, it's not so much when you're going to sell it, what are you going to convert it back into? You know what I mean? I mean, at this point, by selling your gold, you're converting it back into dollars. Well, I'm never going to do that. I'm more curious as to when I sell gold, what am I converting it into? Am I going to convert it into farmland? Am I going to convert it into art? Am I going to convert it into whatever the new global currency is? I have no idea. All I know is my gold's going to see me through it. And if anybody wants to hang out with a bunch of like-minded folks that kind of see it all the same way, that's what TF Metals Report is for. It's primarily a free site. There's a small subscription component where we talk about gold and price changes on a daily basis and do podcasts and things like that. But the site is, like I said, the real value is from the information that all the members provide, all the different links and analysis that the members provide. And so I just encourage everybody to check it out. tfmetalsreport.com. It's a place where we're all preparing for all this that's eventually coming.
Well, that's great. Yeah, and then we'll also have the link for that article that you referenced in the interview. And Craig, thanks so much for taking the time to come on the show with me today. And everyone, be sure to check out tfmetalsreport.com.
Ken, it was a pleasure. Thank you.